Hi everyone, it's Paul Tilley. Welcome back. We're still looking at Chapter 1. In the first video, what I talked about was why accounting exists. What exactly is accounting? What does it record? How does it record it? And what information is given to managers in which they can make decisions from? So we talked about accounting. We talked about generally agreed upon accounting principles, which are methodologies that accountants use in order to be able to record business transactions so that it presents fairly and accurately the actual business to someone so that they can look at it and make a business decision based on that information. What we're going to look at in this video is something called the financial statement. The financial statement occurs at the end of what we call the accounting cycle. The accounting cycle is the process that we're actually learning in this course. We're going to look at the entire accounting cycle. But the accounting cycle starts off with transactions, people buying and selling stuff. So what we do is record these transactions as we go along. Sally came in and bought a bag of donuts. Okay, that sort of thing. So we record those transactions using a method that we use within financial accounting called double entry accounting. We're going to explore that a little bit later on. But effectively, those transactions then move to something called journal entries. And journal entries are putting that information into various what we call journals, or what used to be documents, to indicate sales or changes in the various accounts as things are sold, as things are purchased. We take that information then from the journal and we post it into a summary document called a ledger, and then we make various adjustments to it. And as we move through the year, that entire document is used to create the financial statement. So first of all, if we talk about financial statements. Financial statements are an organization's primary means of financial communication. This is how information is relayed to owners or potential investors or any number of people or organizations that want to get a sense of how the business is doing. An organization's transactions are recorded, classified, sorted, and summarized in order to produce these financial statements. And the whole process of accounting is really wrapped up in this stage, which is keeping track of the transactions, recording them where they need to be recorded so that we can generate these financial statements. There are four major financial statements. They include the income statement, which measures revenues and expenses, the balance sheet, which is, as I say, what the business owns and what the business owes, the statement and changes in equity, which records how the amount of ownership that the owners had as a proportion of the total business throughout the year. And the statement of cash flows, which records what money came in and what money went out of the business. So these statements really provide the critical information that managers need in order to be able to assess the health of the business. And they're all linked together. And our focus today is how are those statements linked to one another? So if we look at financial statements, first and foremost, we have what's called the balance sheet. And the balance sheet is that recording of what a business owns and what a business owes. Now, keep in mind, when we looked at the first video, we talked about the entity concept, meaning that a business is a separate entity. So what we need to do is to calculate all the things the business owns and all the things that the business owes to liabilities to outsiders and owner's equity. In other words, what it owes to its owners, the amount of proportion of the business that is owned by the owners. So the balance sheet is really done at the beginning of the period. It says, okay, this is what we own, this is what we owe. As we move through this timeline process, we record transactions, and those transactions will be revenue coming in, expenses going out. And that's going to create what's called the income statement. The income statement really is a measure of total revenues and total expenses. The income statement then will show how the amount that the owners have invested in the business has grown or shrunk. Normally the profits that a business earns, in other words, revenue minus its expenses, is profits, get added to the owner's wealth. And so owner's equity, if the business makes a profit, the owner's equity will normally go up. If the business loses money, the business would effectively reduce the amount of value that the owners have in the business. These statements then are all used to generate another balance sheet which occurs at the end. And that's going to be a record of what the business owns and what the business owes at the end of the period. Okay? There is a final statement called the statement of cash flows. And the statement of cash flows is really looking at the actual dollars that went into the business and went out of the business during the year. So we've got 2 points in time, the beginning and the end. The income statement measures the changes that occur between the 2 points in time. The balance sheet is like a snapshot. It's a photograph. It says, here's what the business owns and owes at a given point in time. We can look at an example income statement here of organics. So let's see how this typical income statement is laid out. First of all, I want you to note that the income statement is for a period of time. Income statements will always say, this is the amount of time period that we're dealing with. Right here in this particular one, it's from month ended March 31st, 2017. So this is recording a 1 month time period. Okay? The revenues, which record money coming into the business or records revenues coming into the business. It doesn't need to be actual dollars, but it's the flow into the business. Food service revenue, teaching revenue. So the total revenue would come up to $4,100. The expenses that are associated with earning that revenue would include rent expense for $1,000, salary expense for $700, for a total expense of $1,700. The difference between the total revenue and the total expense will give us your profits. So in this particular instance, revenues were $4,100, total operating expenses were $1,700. So the profit is the difference between the two. It would be positive. There was $2,400 in surplus over expenses there. So that is known as profit. Next, we're going to take a look at something called the statement of changes in equity. So the equity is really what the business owners own of the business, out of the proportion of the business's liabilities. This is the liability that's owed to owners. Okay, the business being a separate entity, if it disappeared tomorrow, the owners could pull this much out of the business. Now, in order to figure out owner's equity, all we need to do is take our total assets and subtract the liabilities that are owed to external users of the business or external funders of the business. So pay off all our debts. So simply, if the business liquidated tomorrow, we'd have all of this stuff that the business owns, we'd sell it all, we'd pay off our debts, the liabilities, and whatever's left over would go to the owner's equity. The statement of changes in equity really represents how much the assets belong to the owners, and the owner's equity increases with owner's investment or net income. Obviously, if owners put more money into the business or the business makes money, the owner's equity goes up. If the owners take money out of the business or the business loses money, the owner's equity go down. So if we look at this statement of changes in equity, here we go. And again, the statement of equity is really reflecting a time period. So you need to note that it's for the month ended March 31st. So it's a period of time. It's another period statement. So Haley Walker Capital, March 1st. So we assume that Haley owns this business. The owner invested $10,000 in the business. And we saw in the income statement that there was $2,400 made during that month. In other words, the value of the business went up by $2,400 profit. So that profit gets added to the owner's equity. You know, the business, the value of the business has gone up. So it's a total of $10,000 plus $2,400, which is $12,400. The owner may take money out, and in this particular instance, we saw that Haley Walker took $600 out of the business. This effectively decreases owner's equity as the owner draws money out of the business. The business doesn't owe her that much anymore, so $1,240 minus the $600 that was drawn brings Haley Walker's capital, or owner's equity, it's another word for owner's equity, down to $11,800 at the end of the month period. Next, let's take a look at the balance sheet. The balance sheet, unlike the other sheets, is a point-in-time document, okay? And it reports the assets and the liabilities and owner's equity. So it's linked to the statement of changes in equity. It is linked, and we'll see how that link is made right here, right now. Here's an example of the balance sheet for organic at March 31st, 2017. So what we're doing is we're saying, okay, our period was all of March, and at the end of March, on this date, here is a snapshot of how the business is in terms of what assets it has, what liabilities it has, and how much is owed to the owners. So we'll see, for example, that the business has assets, and assets are the tools that are used in order to make the money that the business makes, okay? So it has cash of $8,400, supplies of $3,600, equipment of $6,000, for total assets of $18,000. Let's look on the other side, and these statements are always presented with assets on the left and liabilities and owner's equity on the right, because assets will equal liabilities and owner's equity. So if we look at the liability section, which is money that's owed to outsiders of the business or people who are not connected with the business, they must be paid at some point in time. We have what's called accounts payable, that's just money that's owed, and notes payable, which is a longer term amount that is owed to someone outside the business. So accounts payable was $200, notes payable was $6,000, for a total liabilities of $6,200. So that's money that's owed to outsiders. Now, if we look at equity, Haley Walker had $11,800 in equity. We pull that information right off the statement of changes in owner's equity. And that gives, in total, then if we add the liabilities and the owner's equity together, that'll come to $18,000. So you'll notice that the assets equal liabilities plus the owner's equity. The final statement that comes once we've calculated the balance sheet is the statement of cash flows. And what we're trying to do there is to get a sense of the sources and use of cash for a period of time for a business. And again, it's a period statement that runs through, in this particular example, March, through a period of time. It's organized by the company's major activities. Generally, a company does three things. It operates, so things that it does in order to run of its operation. It invests money, and financing, which is money that comes in usually through loans or whatever. So the statement of cash flow for organic, for example, looks at, first of all, it is a period statement for the month ended. And we talk about like cash flows from operating activities. What comes in from the actual operating? Well, we saw cash received from clients of $4,100, cash paid to suppliers of $3,400. And you'll notice brackets around it. That means that's money going out, or a negative. Cash paid for rent, $1,000. Cash paid for employee, $700. Notice it's cash. So the net cash used from operating activities was $1,000. So we kind of got a sense for here of money that came in, money that went out in hard cash, and at the end we can do a tally up of how much cash. So cash flows from the operations then was $4,100 minus $3,400 minus $1,000 minus $700 for negative $1,000. In other words, we spent $1,000 more than we brought in. Cash flows from investing activities. There were no recorded investments, so there were no cash flows from investing activities. But there was cash flows from financing activities. The owner put $10,000 into the business at the beginning of the period, and the owner withdrew $600 during the period. So the net cash provided by financing activities was $10,000 less $600, $9,400. So we started out with a cash balance, and what we need to really do is to be able to say, what was the cash balance at the beginning? What is the cash balance at the end? Is it correct? So we started out with no money at the beginning, and at the end, there was $8,400 in that statement of cash flows. So, so that's a general overview of this idea of financial statements. And you really are going to spend a lot of time over creating these in the next few months. We're going to be looking at this whole process that takes us through the accounting cycle, and we are going to generate financial statements at the end. Basically, that's what our course is all about. Thanks for joining me.